quant funds are reeling after their worst trading rout of the year, with momentum stocks taking a beating in the last week. But before you hit the panic button, it's essential to take a step back and look at the bigger picture. Although the recent slump has been painful for quant funds, asset allocators are reminding investors that it's crucial to assess returns over a wider timeframe, and so far in 2026, the sector is still significantly ahead of the S&P 500 in U.S. Treasuries. This is why it matters. When you invest in quant funds, you're betting on a strategy that relies on complex algorithms and data analysis to pick winning stocks, and while it's natural to feel nervous when the market takes a hit, it's crucial to keep a level head and remember that these funds are designed to perform over the long haul, not just in a single week. The key takeaway here is that investors need to stay focused on their long-term goals and not get too caught up in the short-term volatility. And with that in mind, let's shift our attention to the broader market, where futures are looking relatively steady after a record-setting session yesterday. The Dow, S&P 500, and Nasdaq futures are all holding firm, suggesting that the rally that's been building over the past quarter is still on track, and that's a big deal, because it indicates that investors are feeling confident about the overall direction of the economy, and are willing to keep buying stocks even after a stellar quarter. Speaking of which, we just wrapped up the second quarter, and it was a doozy, with stocks surging to new heights. And while there are plenty of factors that contributed to this rally, one of the most interesting trends is the way the dollar has been sinking gold and yen. This is a classic example of how a strong dollar can impact other asset classes, and it's worth paying attention to, because it can have significant implications for your investment portfolio. When the dollar is rising, it can make gold and other precious metals less attractive to investors, which in turn can drive down their prices, and that's exactly what we've seen in recent weeks. Now, let's take a look at what's happening in emerging markets, where South African stocks have been taking a hit, thanks to a decline in the fortunes of the country's precious metals miners. These companies were the heroes of the market just a few months ago, propelling the benchmark index to a record high, but now they're a millstone, dragging the market down towards its worst quarterly slump in almost 3 years. This is a great example of how quickly the market can turn, and why it's essential to stay diversified and not get too caught up in any one sector or stock. As we look to the future, it's clear that the global economy is in a state of flux, and one of the most interesting developments is India's plan to reduce its reliance on Middle East oil following the supply shock of the Iran war. This is a big deal, because it could have significant implications for the global energy market, and it's a reminder that the world is constantly changing, and investors need to stay adaptable to stay ahead of the curve. India's state oil refiners are looking to alternative options, including spot market purchases, which could help to reduce their exposure to geopolitical risk, and this is just one example of how the global economy is evolving in response to changing circumstances. As we wrap up this episode, the question on everyone's mind is, what will the second half of the year bring for investors, and will the market be able to sustain its momentum in the face of rising uncertainty?